You've survived the emotional wreckage of a long-term marriage ending. You've negotiated the retirement accounts, you've decided who keeps the family home, and you've mentally prepared for your new life of independence. But as you sit in your attorney's office, pen in hand, ready to finalize your freedom, there is a silent financial predator waiting for you. It is a phenomenon known to top-tier financial planners as the Medicare Cliff. For women over 50 in the United States, health insurance is not just a line item in a budget. It is your most critical asset. If you have been covered under your husband's employer-sponsored health plan for decades, you are currently protected by a fragile glass bridge. The moment that divorce decree is signed, that bridge shatters. If you are 55, 59, or 62, you are in the red zone. You are too young for Medicare, too expensive for private insurance markets, and potentially one medical diagnosis away from losing every single dollar of your divorce settlement. Today, we are moving beyond simple advice. We are conducting a rigorous, academic, and strategic investigation into the healthcare crisis of gray divorce. We will dissect the brutal mechanics of COBRA, the hidden dangers of the Affordable Care Act for high-asset divorcees, and the top-secret legal maneuvers that can keep your coverage intact until you reach the safe harbor of age 65. This is the financial survival manual for your second act. You have worked too hard to let an insurance company take your future. To understand why this cliff is so dangerous, we have to look at the structural mechanics of American law. Most corporate health plans in the U.S. are governed by a federal law called ERISA, the Employee Retirement Income Security Act. Under ERISA, an employer is only legally obligated to provide coverage for an employee and their legal spouse. The legal separation paradox: the second you become an ex-spouse in the eyes of the court, you are legally a stranger to that insurance company. There is no grace period unless specifically negotiated. Academic research from the Kaiser Family Foundation shows that healthcare is the single largest out-of-pocket expense for retirees. For a divorced woman over 50, this burden is often doubled or tripled because she no longer benefits from the family plan's discount. While your ex-husband keeps his corporate plan at the same subsidized rate, your costs don't just increase, they transform into a different financial beast entirely. The socioeconomic toll. Academic studies on the economics of gray divorce highlight a staggering trend. Women experience a significantly higher rate of post-divorce poverty than men. A major contributing factor is the fixed cost explosion. When you lose access to a group health plan, you aren't just paying for a doctor. You are paying for the massive administrative overhead of being an individual in a system built for families. This is the structural inequality that we are here to dismantle today. Your lawyer might say, "Don't worry, you have COBRA rights." This sounds comforting, but it is a financial trap disguised as a safety net. Let's break down the math. COBRA, the Consolidated Omnibus Budget Reconciliation Act, allows you to stay on the plan for up to 36 months. However, the dependent subsidy is gone. In a standard corporate plan, the employer pays about 70% to 80% of the premium. When you switch to COBRA, you pay 100% of the premium plus a 2% administrative fee. A $400 monthly deduction from your husband's paycheck suddenly becomes a $2,200 monthly cash payment from your bank account. Over a 36-month period, that is nearly $80,000 of your post-divorce capital evaporated just to keep the status quo. And here's the most dangerous part. What happens at month 37? If you are 59 when you divorce, your COBRA ends when you are 62. You still have 3 years until Medicare. This gap within a gap is where medical bankruptcies happen. If you develop a chronic condition during those COBRA years, finding an affordable private plan at age 62 will be nearly impossible. You must plan for the entire bridge, not just the first 3 years. Let's examine a real-world scenario. Consider Deborah, a 61-year-old woman who finalized her divorce after 30 years of marriage. Her settlement gave her $300,000 in liquid assets, a sum she thought would last her decades. But Deborah was 4 years away from age 65. Deborah used COBRA for the first 3 years, which cost her $75,000 in premiums alone. In the 4th year, she was forced into the private market. Because of her age and a minor heart condition, she was placed in a high-premium, high-deductible plan that cost another $25,000 for the year. Then the unthinkable happened. She needed a routine surgery that hit her $10,000 out-of-pocket maximum. By the time Deborah received her Medicare card at age 65, she had spent over $110,000 on health care. More than 1/3 of her entire divorce settlement was gone before she even started her retirement. If Deborah had utilized a strategic delay or a legal separation decree, she could have stayed on the subsidized plan and saved nearly $90,000. This is the brutal, unforgiving math of the Medicare Cliff. Don't be Deborah. Be the woman who plans ahead. How do we beat the system? You have to be more strategic than the insurance companies and more informed than your attorney. Here are the elite tactics. Tactics 1. The legal separation bridge. In states like New York, California, or Illinois, you can seek a judgment of legal separation instead of a final absolute divorce. For many insurance providers, a legally separated spouse is still a legal spouse. This allows you to stay on the family plan at the subsidized rate until you hit 65. You only sign the final divorce papers once your Medicare card is physically in your hand. Tactics 2. The bifurcation of marriage. If you absolutely cannot stand to be married a moment longer, ask your attorney about bifurcation. This legal move splits the divorce. It grants you the medially single status but keeps the economic issues, like the healthcare obligation, under the court's jurisdiction. It creates a legal shield that prevents the insurance company from dropping you while the final financial details are ironed out. Tactics 3. Negotiating insurance parity as alimony. Do not accept a flat alimony rate. Your attorney must demand that the premium delta, the difference between the old subsidized rate and the new COBRA rate, be paid as a separate tax-neutral line item. If your ex-husband's company is saving money by removing you, that money should be redirected to your premiums. In the eyes of the law, health insurance is a need, not a luxury. Tactics 4, HSA equity transfers. Health savings accounts, HSAs, are one of the most overlooked assets in a divorce. If your husband has been maxing out his HSA for years, that money belongs to you too. Under Internal Revenue Code, Section 1041, an HSA balance can be transferred to an ex-spouse tax-free. If there is $50,000 in that account, fight for it. It is tax-free money that can be used to pay your premiums or any future medical bills without touching your savings. Tactics 5. The QDRO medical clause. A qualified domestic relations order, QDRO, is usually for 401s, but it can be drafted to include specific medical contingencies. You can earmark a portion of the retirement assets specifically for health bridge expenses, ensuring that if medical costs rise, the funds are already there, protected from taxes and penalties. As you approach the cliff, you might look at the Affordable Care Act, ACA, marketplace. But here is a technical danger. Marketplace subsidies are based on your Modified Adjusted Gross Income, MAGI. If your divorce involves selling your primary residence or taking a large lump sum distribution from a retirement account, your income for that year will look massive on paper. This will disqualify you from subsidies, meaning you will pay the highest possible premium for a plan with a massive deductible. You must coordinate your asset liquidation with your tax professional. Selling the house in the same year you apply for health insurance is a $20,000 mistake. You must time your exit from the marriage just as carefully as you time the sale of your assets. Timing is everything. Finally, we must talk about the transition to Medicare itself. Many women believe that once they turn 65, the nightmare is over. But if you have been on COBRA, there is a technical trap. Medicare has very strict special enrollment periods. Many people mistakenly think having COBRA counts as active employment coverage. It does not. If you wait until your COBRA ends to apply for Medicare Part B, you might find yourself in a general enrollment period, leading to months without any coverage and lifetime late enrollment penalties. That is a permanent 10% increase in your Medicare costs for every year you were late for the rest of your life. You must apply for Medicare exactly 3 months before you turn 65, regardless of whether you are still on COBRA or not. Don't let a clerical error ruin your retirement budget. We have covered the brutal statistics, the legal loopholes, and the high-stakes math of the Medicare Cliff. The message is clear. Do not let your desire for a clean break lead to a financial fracture. A divorce after 50 is not just the end of a relationship, it is the rebuilding of your entire financial infrastructure. Healthcare is the foundation of that infrastructure. Before you sign that final decree, I want you to take this video to your legal team. Demand a healthcare bridge strategy. Demand that your ex-spouse covers the premium gap as part of your settlement. You have worked too hard, sacrificed too much, and built too much life to have it all taken away by an insurance company's fine print. You deserve a second act that is defined by freedom, not by medical debt. Thank you for being part of this community. We are building a future where women over 50 don't just get by, they lead. If this academic deep dive gave you the clarity you needed to protect your future, please subscribe and share this with another woman who might be standing on the edge of the cliff. In our next video, we are revealing the survivor benefit secret. How the government owes you a fortune if your ex-spouse passes away, even decades after your divorce. Stay informed, stay protected, and stay empowered. Your strongest years are still ahead of you. I'm Gray Divorce Guide, and I'll see you in the next one.